In 1993, a financial product was created that most people have never fully understood. Yet it is now one of the most widely held investments on the planet. As of February 2026, there are over $21 trillion invested in ETFs globally. More money than the entire GDP of every country in the world, except the United States and China. And the reason most people do not understand ETFs is not because they are complicated. It is because nobody has taken the time to explain them simply. That changes right now. This is week 4 of the Algorithm Investor. Today we are going deep on ETFs, what they are, how they work, why they matter, and exactly how to use them to build long-term wealth. Let us start with the name. ETF stands for Exchange Traded Fund. And if we break that down word by word, it tells you almost everything you need to know. Exchange. It trades on a stock exchange just like a regular share. You can buy and sell it any time the market is open, at real-time prices throughout the trading day. Traded. You buy and sell it through a brokerage account exactly the same way you would buy a share of Apple or Microsoft. Same process. Same account. Fund. It holds a collection of investments inside it. Not one company. Many companies. Sometimes hundreds. Sometimes thousands. Put those 3 things together and you have it. An ETF is a fund that holds many investments inside it and trades on a stock exchange like a regular share. Now you might be thinking, is that not exactly what an index fund is? And the answer is almost. They are very similar, but there are important differences worth understanding. An index fund is typically a mutual fund, meaning you buy it directly from the fund company at the end of day price, not throughout the trading day. You cannot sell it at 11 a.m. and buy it back at 2 p.m. It settles once per day. An ETF trades throughout the day at real-time prices just like a stock. You can buy it at 10 a.m. and sell it at 3 p.m. if you choose. This gives ETFs more flexibility than traditional index funds. Both can track the same index. Both can hold the same companies. The ETF just wraps those holdings in a structure that trades on an exchange in real time. For most long-term investors, this distinction does not matter enormously. You are not going to be day trading your retirement savings, but it is worth understanding the structure. So why are ETFs so popular? There are 5 reasons that explain why $21 trillion has flowed into them. Reason 1. Diversification. One ETF purchase can give you instant ownership of hundreds or even thousands of companies simultaneously. The SPY ETF, which tracks the S&P 500, holds all 500 companies in a single purchase. Reason 2. Low cost. ETF expense ratios are among the lowest in the investment world. VOO, Vanguard's S&P 500 ETF, charges 0.03% per year. That is 3 cents per $100 annually. Remarkably cheap for what you get. Reason 3. Tax efficiency. ETFs have a structural advantage over mutual funds when it comes to taxes. The way they are created and redeemed means they rarely generate taxable capital gains distributions. This matters significantly in taxable brokerage accounts. Reason 4. Transparency. ETFs disclose their holdings daily. You always know exactly what is inside the ETF you own. Mutual funds typically only report holdings quarterly. Reason 5. Flexibility. ETFs exist for almost every conceivable investment strategy. U.S. stocks, international stocks, bonds, real estate, gold, commodities, technology, healthcare, dividends. If you can imagine a strategy, there is probably an ETF for it. Now let us talk about the main categories of ETFs and what each one does. First, broad market ETFs. These are the foundation of most long-term portfolios. They track a major market index and give you exposure to a large slice of the market in one purchase. VTI. Vanguard. Total Stock Market ETF. Holds over 3,600 U.S. companies. Every size, every sector, the entire U.S. stock market in one fund. Expense ratio 0.03%. VOO. Vanguard S&P 500 ETF. Holds the 500 largest U.S. companies. The most widely used benchmark in investing. Expense ratio, 0.03%. VT. Vanguard Total World Stock ETF. Holds approximately 9,000 companies across the entire global stock market. U.S. and international combined. For investors who want truly global exposure. Expense ratio, 0.07%. Second, international ETFs. For exposure beyond the United States. VXUS holds international stocks from developed and emerging markets outside the U.S. VEA covers developed international markets. VWO covers emerging markets specifically. Third, bond ETFs. Bonds are loans you make to governments or corporations in exchange for regular interest payments. BND. Vanguard. Total Bond Market ETF. Gives you exposure to thousands of U.S. bonds in a single purchase. Bonds tend to move in the opposite direction to stocks during market downturns, which makes them a useful stabilizer in a balanced portfolio. They generate less return than stocks over time, but significantly less volatility. Fourth, sector ETFs. These focus on specific industries rather than the whole market. XLK for technology, XLV for healthcare, XLE for energy, XLF for financials. These are more concentrated and therefore higher risk than broad market ETFs. Fifth, dividend ETFs. These focus specifically on companies with strong dividend histories. SCHD, Schwab US Dividend Equity ETF, is one of the most popular. It holds companies with consistent and growing dividend payments. Now let us build the simplest possible ETF portfolio that covers everything most investors need. The 3-fund portfolio is the most widely recommended starting framework in evidence-based investing. It has been championed by academics, financial advisors, and the Bogleheads community for decades. Fund 1, VTI or VOO, your U.S. stock market core. This is the engine of your long-term growth. Allocate 60% of your portfolio here. Fund 2, VXUS, international stocks. This gives you exposure to growth in Europe, Asia, and emerging markets. Diversifies your geographic risk. Allocate 30% of your portfolio here. Fund 3, BND, U.S. bonds. This is your stabilizer. It reduces volatility and gives you something that holds value when stocks fall. Allocate 10% of your portfolio here. That is it. 3 ETFs. Total global diversification. Extremely low fees. Minimal maintenance. This portfolio is genuinely competitive with portfolios that cost thousands of dollars in financial advisory fees to construct. As you get older and closer to retirement, you gradually shift the allocation, reducing stocks and increasing bonds. A common rule of thumb is your age as your bond percentage. At 30, 30% bonds. At 50, 50% bonds. At 65, 65% bonds. This is called a glide path. Your portfolio automatically becomes more conservative as your time horizon shortens and you need your money to be more stable. One more thing worth understanding: ETF expense ratios and why they matter more than most investors realize. Expense ratio is the annual fee the ETF charges to manage the fund. It is deducted automatically from the fund's returns. You never see a bill. It simply reduces your return slightly each year. The difference between 0.03% and 1% sounds trivial. On $10,000, it is $97 per year. Over 30 years on a growing portfolio, it is tens of thousands of dollars in lost compounding. Always check the expense ratio before buying any ETF. For broad market index ETFs, you should never pay more than 0.11% per year. The Vanguard, Fidelity, and Schwab ETFs we discussed today are all well below this. Here's the bottom line on ETFs. They are not complicated. They are not exotic. They are simply the most efficient vehicle most ordinary investors have ever had access to. Low cost, diversified, tax efficient, transparent, flexible, and available to anyone with a brokerage account and any amount of money to invest. The financial industry spent decades making investing feel complicated because complexity justified high fees. ETFs removed most of that complexity and most of those fees simultaneously. That is why $21 trillion has poured into them. And that is why understanding them is one of the most valuable things you can do for your financial future. Next week on The Algorithm Investor, Week 5, we are going into the psychology of investing, why smart people make terrible financial decisions, and the specific behavioral traps that cost the average investor 3 to 4% per year without them ever realizing it. For the full breakdown on everything you need to build real wealth, subscribe to The Algorithm Investor. New video every single week. Drop a comment below. Do you currently own any ETFs? Which ones? I read every single comment. See you next week.